Good morning, everyone, and welcome to today's webinar, Non-QM 101, Understanding the Loan Options for Today's Borrowers. Now, we want this to be as engaging for you as possible. So as questions come up, please go ahead and use the little questions tool, and I will ask the speakers for you on your behalf. We'll also have a little bit of time after the webinar for any additional questions. With that, I'm going to turn it over to our speakers. Take it away, Christian.
Okay, just want to start off with some quick introductions. My name is Christian Drews. I'm a regional manager here with LendSure Mortgage. Been at the company for about 5 years, and I'm located here in Salt Lake City, Utah. Turn it over to Parker.
Hey guys, I'm Parker Siebel. I'm on Christian's team. I'm an account executive at LendSure. I've been here for about 3 years. I'm originally from Colorado, but I also work in the Salt Lake office now.
How's it going, guys? My name is Raymond Hashimi. I'm located at HQ here in San Diego. I spent a couple years as a banking analyst, then underwrote hard money loans before working as an analyst for Freddie Mac portfolio, and now I originate fix and flip and ground up loans for LendSure.
Awesome.
Perfect. Thanks, guys. Hey, let's quickly get into today's agenda. Before we get into the meat and potatoes of the webinar today, there will be a quick slide about who we are here at LendSure, followed by another quick slide about what we do versus what we don't do, and then from there we'll get into the agenda you see here. So we'll start off with non-QM borrower profiles, who it helps the most, who do we need to be aware of in today's market to help identify as many loans as possible. From there, we wanted to segue and start off with programs that are unique to LendSure. Specifically, we will begin with our Boost Bridge loan, followed by our less than 1 year self-employed program. And then Raymond here will then pick it up and talk about our fix and flip program. Following that, we will get into more of the typical menu of non-QM programs. So we'll have Parker go in depth about bank statement loans. We're actually going to move asset depletion up to follow bank statements. As a reminder, we can combine those income types, so we wanted to talk about those in tandem. After which we'll get into different types of investor loans, how to position these investor programs to help build more fruitful relationships for repeat business. We'll discuss specialty property types such as non-warrantable condos and condo hotels, and then we'll round out the programs by discussing foreign national loans. And then last but not least, we did want to briefly mention the LendSure process, specifically how we approach loans up front, and then make sure that all of you are aware of some of the resources you have available to you with our pricing engine, as well as some co-branded marketing material. So with that, Rose, next slide, please. Okay, real brief, just quick bullet points about us. LendSure Mortgage was founded in 2015. We are headquartered in San Diego, California. But with that said, we do have a national presence with offices around the country in Rhode Island, Georgia, Salt Lake City, which is where Parker and I are located, and Missouri. We've been securitizing loans annually since 2017. We do have a highly experienced management team, coupled with a very important relationship that we have with our main investor, Ellington Financial. Main reason I want to bring up that relationship is Ellington Financial has given us the capability to grant many loan exceptions. We're actually the industry leader in granting exceptions on loans, where about 40% of all the loans that we fund have some sort of exception on them. So again, we want to make sure that you guys are aware of that, because later on we will introduce our pricing engine, but we want to make sure that more importantly you are connected with your account executive to be able to talk through these exceptions that the pricing engine may not be able to handle. And then lastly, we are lending in all 50 states with the exception, or I should say slight exception, of New York, where we are currently only able to do non-owner occupied. Next slide, what we do. Here at LendSure, we really focus on making good loans, which may or may not qualify for conventional guidelines. So as mentioned, we have the typical menu of non-QM programs such as bank statements, asset depletion, DSCR, and other investment property cash flow programs. Our main focus here is that we really serve the just missed a paper borrower, right? Our average securitization, I should say our securitizations average a FICO of 700 plus and LTVs under 70%. Just as an FYI, that doesn't mean our max LTV is 70%. That's just where the averages land. But again, the point is that we are not a subprime lender. We deal with very quality, credit-worthy borrowers. What we don't do, we do not do any of the government backed loans such as Fannie Freddie, FHA, VA, HARP, foreclosure bust outs, builder bailouts, no second mortgages or home equity loans.
Okay. And I have a question from Tim. Yes, Tim, this webinar is being recorded. And yes, I will send a copy of the slide deck out to everybody. Look for an email about an hour after the webinar ends from me, Rose Waldy, and that will have that information plus some additional resources.
Alrighty, so let's get into the meat and potatoes. So non-QM borrower profiles, who it helps most. So again, I want to reiterate that non-QM does not equal risky lending. Non-QM here at LendSure is about serving qualified borrowers who don't fit inside that conventional box. These are high quality borrowers whose financial strength just isn't reflected on your traditional W-2 or your tax return. So what are the borrower profiles we want to focus on? Well, first and foremost, we want to focus on self-employed individuals, whether that be business owners, 1099 earners, entrepreneurs, and freelancers. Quick fun fact that I think is important for all of us to know, in 2023, there was about 73.3 million self-employed or freelance workers within the United States. By the year 2028, it is estimated that there will be over 90 million. And so as brokers and lenders, as we look at the trajectory of the market, it's obviously vital for our own success and for us to continue to achieve our goals that we are ready for this growth and we have viable solutions to be able to help out this ever increasing growth of self-employed borrowers. So with that said, what are the challenges that we face with self-employed borrowers? Well, it's pretty simple. Self-employed borrowers are writing off expenses to reduce their taxable income, which in turn is making them look weaker on paper than they actually are. So here at LendSure, we prefer to take a alternative route, and we would like to look at the cash flow of the business by collecting bank statements, for example, to be able to paint a different picture of the actual income strength or financial stability of that business rather than just going off the tax returns. Okay, so that's the first profile. The second non-QM borrower profile that we want to focus on are asset-rich but potentially income-light borrowers. These are clients who have very healthy assets. These assets can be held in things like stocks, retirement, really just their overall liquidity, so checking and savings, but potentially show little monthly income. So instead of just disqualifying these borrowers, we use programs such as asset depletion or asset qualifier to convert this asset picture into qualifying income. Essentially, if you think about it, we are aligning their financial strength, which we can clearly see on paper, with qualifying rather than aligning their paycheck or lack of paycheck with qualifying. So that's the second one. The third one we want to focus on is real estate investors, especially those with scaling portfolios. Traditional lending can slow these guys down because of DTI constraints and even property limit constraints. Here at LendSure, we solve this problem by focusing more on the income generated by the property itself, such as a DSCR loan, rather than the borrower's actual income that they have themselves. This allows investors to seek faster, this allows investors to scale faster and continue acquiring more properties without hitting those conventional ceilings. So that's the third one. And then the last one, foreign national borrowers. The true definition of a foreign national, just so you guys are all aware, is borrowers who live and work outside the United States. These are borrowers that even though they live and work outside the United States, they are looking to invest into the US real estate market, but they don't have the US credit or the US income or US documentation in general to qualify. So what we will do is we will use alternative documentation, which we'll talk about here later, to tap into this massively underserved market that's out there today, an opportunity. So at the end of the day, the main thing that I want all of us to recognize here, and kind of this message that I'm trying to portray, is that all of these profiles have one thing in common. And that's that these are all very strong borrowers. They just don't fit conventional guidelines for some reason. So here at Lenture, our goal is to give you the ability to say yes way more often. We want to give you the ability to expand your reach and serve more clients that other lenders just can't. So with that said, Rose, next slide, please. Let's go ahead and get into some of the solutions that we have to meet those profiles.
So the first one that we'll talk about that is unique to Lenture, you'll see that other people have bridge loan options, but this bridge loan that we have is completely unique to Lenture because of the structure and how it works. So this one's called our Boost Bridge Loan. Boost stands for Bridge Option Offering Seamless Transition, which is exactly what it is, the buy before you sell with the seamless transition. If you can go to the next one, Rose. So what it is it's a buy before you sell, right? So you're bridging the gap between your new home before you sell your old home. And so we're accessing the equity in your departing property and using that equity and that cash for the down payment on your new purchase property. Go to the next one, Rose. So what are the benefits of the Boost Bridge Loan? Well, number one, the main difference of ours is that there's no monthly payments. So we're fixing multiple things within the same transaction, the same product. So ours has no monthly payments. So not only does it fix the DTI issue because we're not hitting them for a payment on the departing property, we're only qualifying them on the new property. So those borrowers who can't carry 2 mortgage payments, their DTI is too high on the new purchase, our bridge loan is perfect for them. So not only does it fix the DTI issue, but it also fixes the assets issue of accessing that equity and allowing these borrowers to make a non-contingent offer. Go to the next one, Rose. Oh, never mind. I thought we had another one. So I'll tell you how it works. So if you want to go back one more, Rose. So how it works is we're doing a 75% cash out refi on the departing property. We're using that funds, that equity to pay off the existing lien and give the remaining as down payment into the new purchase property. The reason that we structure it that way is because now Lenture is in first lien position on the departing property, and we're structured as a 12-month balloon note due when the property sells. So we don't have any monthly payments. We paid off the previous lien on the departing property, so there's no monthly payments there. So now Lenture is also doing the new purchase property. And so since we have first lien position on the departing property, we're in first lien position on the new property. We don't have to hit them for any monthly payments. We're giving them up to 12 months to sell. So it fixed the DTI issues. We fixed the equity issues, and the non-contingent offer allows them to be competitive on the new purchase. So Lenture is a lot cheaper than a lot of other bridge loan lenders as well, because we're charging our points on the loan amount compared to a lot of other bridge loan lenders are doing a backup offer, a backup guaranteed offer, and they're charging their points on the sales price compared to ours is on the loan amount. So not only are we cheaper, we give them up to more time, up to 12 months to sell, and we're fixing all of the same issues at once.
Parker, Brad wants to know, can you please price a scenario for a bridge loan? Brad, if you have a specific scenario, then please go ahead and respond to the email, and I'll connect that you're going to get after the webinar, and I'll connect you with your Lenture account executive. But Parker, can you talk a little bit more about pricing?
Absolutely. Yeah. So this is one of the loans that I actually do most of. This one and the next one, the less than 1 year self-employed. For example, I'm doing 2 this month, 2 different Boost Bridge loans. So the bridge portion is always, no matter what, priced at 8.5%, and that's interest accrued due when the property sells, right? So there's still no monthly payments on that. The new purchase, I've done 2 this month. They're both at a 6.99 rate. That's with good borrowers, and we can go up to an 80% LTV on the new purchase. So those are, one of them's they're both at 80% LTV on the new purchase, good credit, and the new rate is a 6.99. As a rough example, I would say expect high 6s, low 7s for the new purchase, and then always an 8.5% on the bridge rate.
One thing I would like to add as well is, I guess, highlighting the power of the non-contingent offer, right? As loan officers, or whatever sector of the mortgage industry we're in, we're always trying to make a good impression on the people we partner with, right? We're always trying to bring value that maybe others don't have. And so I really want to again highlight the non-contingent offer, because that gives your realtors so much more to work with than they would, right? So number one, when we use a bridge loan, it now allows your realtor that you're working with to properly stage the departing home, to be able to properly list it and be able to sell it for top dollar, right? Rather than your borrower finding, their dream home, putting the home up for a fire sale, and maybe slashing purchase price by 20, 30K. Okay, so that's the first thing. You're giving your realtor the time to do their job correctly. Okay, so how much money is that going to save? The second thing, the power of the non-contingent offer when we are negotiating either sales price or even seller concessions with the new seller on that purchase loan, right? When we talk about the cost of a bridge loan, it's important to also talk about the cost savings by, again, using that non-contingent offer to, get 2 to 3% in seller concessions. As an FYI, on owner-occupied transactions, we do allow for 6% seller concessions, and on non-owner occupied up to 3%. So keep that in mind. It is a very powerful tool. Okay. All right. No other questions on that. We'll keep chugging along. So career professional loans. I'll talk about this one. This is definitely my favorite program, mainly because it really speaks to our mantra here at LendSure, and that is that we are a common sense lender, right? We make common sense exceptions, as I mentioned before, right? And so I always like to introduce this program by giving a very brief backstory. About 4 or 5 years ago, we were working with a broker here in Salt Lake City, and we kept getting the same loan scenario over and over again. And that scenario was, hey, Christian, I got this W-2, or excuse me, I have this physician, or I have this anesthesiologist or this dentist that has been W-2'd in the industry for 5+ years, whatever it was. But a couple months ago, maybe it was 2 months ago, 6 months ago, whatever, they just became self-employed. They just became 1099, right? A lot of times they became 1099 for the same hospital, right? So then we start to ask the question, well, why did they leave the W-2 job and go 1099? Well, 9 times out of 10, maybe 10 times out of 10, we find out it's because they're guaranteed to make more money, right? But due to the fact that Fannie and Freddie have no options for self-employed borrowers under 2 years, let alone under 1 year, they had no outlet for that type of loan, right? But then as we continue to look at the rest of the file, we ask about credit. How's the borrower's credit? Well, it's excellent. They have 740 plus. How does the borrower's asset picture look? It's excellent. They got 12+ months of reserves, right? What are they putting down on the property, right? 20%, 15%, 25%, whatever. We had overall this very strong file. And so anyways, we got enough of these scenarios to where we actually took it to the president of our company, Joe Leiden, and we said, hey, Joe, we're getting these scenarios over and over again. Do you think we can, create, kind of a de facto program out of this? And, sure enough, our less than 1 year self-employment program came to be. And since then, I would say this is probably, aside from the bridge loan, the most common loan that we fund. So to get into some of the details of it, and there's one thing I want you to take away today about how this program works, is anytime you come across a borrower that has less than a year of self-employment history, the only question we really need you to ask the borrower is, have you been in the same line of work for 2+ years? If the answer is yes, then we have a good shot at structuring something, okay? Now, this is not a loan where you'd want to go price it out in our Spark pricing engine, which we'll talk about later, because they're so unique in the structure based on each one, right? We'll have some borrowers that have been self-employed for 2 months versus others that are self-employed for 9 months. We'll have some borrowers that have a guaranteed 1099 work contract that has a guaranteed salary where others don't have a contract at all, right? So point is, each loan is approved really on a case-by-case basis, depending on the overall strength and risk of that file, right? So I like to present this with 3 quick examples to give you guys an idea of LTV ranges. So the first one would be if we had, for example, a physician that has a guaranteed 1099 contract with a salary, right? The salary might say that they're guaranteed to make $300,000 per year. In a case like that, we would really just need 1 pay stub or 1 bank statement to be able to show that the deposit for that first payment matches up with the annual salary amount to match that contract, right? Something like that is very sturdy. So when we combine that with good credit, assets, I've gotten deals like that approved at 90% loan to value before for owner occupied transactions, which is our max LTV. The second example, so the middle ground is take that same example, but they don't have a guaranteed salary. Instead, the work contract has more of a per shift type pay rate, right? So something like this, it's harder to be able to annualize out what they're going to make. So we might want to see a little bit more history. So instead of 1 month on the job, like we would do with a salary, maybe we want to see between 4 to 6 months, right? With that, we would collect the 4 to 6 months of bank statements. We would look at the deposit trends for those 4 to 6 months and be able to then match that up to the contract and say, okay, what is the trajectory of this borrower's income? If we like it and it looks strong, we've gotten those approved to 80 to 85% loan to value, right? Final example I'd like to provide is, and this is a real loan. We had a W-2 dentist who purchased a existing practice. It was actually the practice he was working for, and he had been the 100% business owner for 3 months by the time the loan got to us. So when we look at this compared to a 1099, this dentist had a lot more responsibility as a true business owner, meaning they had employees, they had actual costs of equipment, a lot more overhead is the point, right? So for somebody like that, we were actually able to look at the previous business owners' last 2 years of financials as the borrower that purchased the business did their own due diligence to look at the financial well-being of the business before buying it. And then we compared that to the 3 months of bank statements that our borrower had since taking over. And we saw that the income was very consistent with how it was previously operating. So for something like that, a borrower that bought a new existing business, we approved that at 70% loan to value. So again, point being, LTVs vary. Call your account executive and we'll kind of walk you through how we structure these things, but hopefully that gives you a good idea. And then again, the main thing is just, there's a lot of information there. The main thing is just remember, if you can ask that one question, have you been in the same line of work for 2+ years and, you can likely do something.
Yeah, the only thing I would want to add in here that a lot of people ask me is it have anything to do with certain industries? And it does not. We do not, it doesn't have to be a doctor, a dentist, a lawyer, anything like that. I just did a 2-month self-employed financial planner. I've done 6 months self-employed landscapers. It doesn't matter the industry type. It does matter how long they've been in the industry and how strong our file is the only thing that I would add there.
Yeah, fantastic point. Another good example is truck drivers, right? So thank you, Parker, for adding that.
Okay. And Tim, I hope that answers your question about calculating income for less than 1 year. So please follow up if you have any follow-up questions. Carla wants to know, what about self-employed individuals that work and live in the U.S. with an ITIN?
So with ITIN borrowers specifically, we have a ITIN program. And so with that program, I will say that there's less exceptions typically. And we would just need to make sure that we really fit LTV requirements, which is maxed out at 75%. With the ITIN loan, the max loan amount is $500K. But if we have a strong borrower that has experienced the same line of work and is making good income in a self-employed world now, then absolutely we take a look at it.
Okay. And then Isis wants to know, what about new loan officers? I know you said you cover multiple borrowers, but I'm curious.
I'm afraid I'm not understanding the question.
Isis, if you could follow up on that comment, please. Thank you.
Is she saying if their line of work is a new loan officer? That's how I understood the question.
Like if she's a new loan officer and she wants a loan for herself.
Okay, so if that's the question, so good point. So when we talk about same line of work, first off, I want to make sure that we're clear on what that means. Same line of work is truly you're doing the exact same thing. So sometimes we'll get scenarios where we see, hey, we had a W-2, I'm trying to think of a payroll salesman. I'm using that because that was my previous career, a payroll salesman before, and now they are, let's say, a 1099 realtor, right? It's both sales, right? But it's not the same industry. So something like that would not qualify. So in your position, if you're a brand new loan officer, I would assume that you're obviously most likely W-2. We would probably need more history there just because it is a commission-based job, right? So that one would fall in a bit of a different landmark.
Okay, Christopher, I hope that answers your question. Please go ahead and follow up if if you need more clarification.
All right, I guess this is me, huh? Lenture, fix and flip, and ground up construction. We all know that, including myself, a lot of us aren't going to be winning our brackets. Let's see how we can make some money on the fix and flip and ground up side this year. Next slide, please, Rose. All right, our Lenture fix and flip program. This is a pretty innovative product that we offer. It is super competitive, and I'm not just saying that because I work here. I used to underwrite loans for a hard money lender, and what we do here is honestly pretty impressive. I'll start off by giving you guys a brief overview of how myself and anyone else on my team would approach any loan scenario. Essentially, we look at a deal as if it has four legs. One is going to be the location of the property itself. What submarket is it located in? Is it rural, etc.? If it is rural, we want to check where the nearest MSA is of a population of 30 to 50,000 or more. Then we're going to shift our focus to assets. Does your borrower have enough to cover the down payment if it's a purchase? If it's a cash out refinance, what's the purpose of the cash out? We want to make sure that post close we have enough liquidity for 6 months of reserves, 10% of the rehab budget, etc. Really, when it comes to pricing and leverage, we zoom in on two separate things. It's going to be your borrower's experience paired up with their credit. Now that shifts me to this next bullet point here, any level of investor experience. This is where I like to say that we separate ourselves from a lot of other lenders. We don't shy away from first-time flippers or even ground-up investors. And I'll give you an example. A borrower comes to us with no experience, and by experience, what we categorize experience as is for a fix and flip loan, for example, fix and flips that your client has done in either their own name or in their LLC's name in the last 36 months. That's what we qualify as experience. And I'm going to use numbers to categorize experience here. So say you've done one flip in the last 3 years. We categorize that as getting dropped into our 80% LTC bucket. Say you have no flips in the last 3 years with a 660 FICO, which is our minimum. We're going up to 80% of total project costs in that scenario, which is relatively aggressive for a first timer. So say you got a purchase price of 400,000, a rehab budget of 100 grand. You're a first timer with a FICO of 660. We're comfortable with assets and the property itself. We're able to go up to 80% of your total cost basis, which would be your purchase price added up with your rehab budget, 500 grand total cost basis. We'll end up to 80% of that. So $400,000 total loan amount in that scenario, back out 100% for the rehab. We give you 300 for the purchase. I know it's a little bit confusing, but just want to give some high level overview of it and how it sort of works on our end. Now come to us and say, oh, I've done 3 flips in the last 3 years in my LLC's name. Perfect. We verify those flips, check out the sale date, make sure it all lines up. And from that point on, you get up to 90% of total project costs. So we do have programs that get pretty aggressive, and they're heavily driven by investor experience. I would like to note on that, a lot of people come to us and they say, oh, my borrower's a GC. He's done 20 flips in the last 3 years. Unfortunately, we can't consider that as experience because those are builds that he's done for other people, not necessarily for himself. It's like when you're working as a loan officer and you want to go open up your own shop, completely different ballgame. So although it is a plus for those borrowers who are builders themselves, as we can get comfortable with them self-performing the project, that's how we categorize experience. Loan scenarios reviewed very quickly. Our team is super high touch. Our fix and flip team has grown quite a bit in the last couple of years. And we like to, prioritize getting back to our LOs, brokers, borrowers directly if it's a retail deal as quickly as possible. I got in a loan request this morning at around 8 a.m. I shipped off a quote at 8:15. I can get back to people very quickly, and the same goes with anyone else on my team. And as you'd expect, these are for people who are in the business of buying distressed properties, repairing them, and reselling them. Common sense underwriting service levels you'd expect with our programs. We got a great underwriting team here. They're extremely diligent. Sometimes it makes me a little frustrated how diligent they are, but we got a great team here. And for you brokers out there, our terms for fix and flips are usually 12-month interest only. Always have 1 month built-in interest reserve at the minimum. We can build up to 3 to 6 months dependent on your borrower's experience and assets. But there's no EPOs, no prepayment penalty for your borrower. If they can flip the property in 6 months, glory to them, all the better. No exit fees, none of that. We do not need any income analysis, and we do not require debt to income ratios on our product. Like I said, it's heavily driven on assets, location of the property, experience, and credit. Exit strategy: buy, repair, sell, buy, repair, hold. If it's going to be a true fix and flip where you're going to sell it, we're just going to want to make sure it meets our profitability metrics. And we sort of focus on that very, very hardly during underwriting to make sure that you're going to be good, and your property is going to be profitable. We check your ARV, send out an appraiser if the loan amount requires it. I think it's 450 or above. We're going to order a full appraisal on the property. Make sure you're going to be profitable, so you're not left in the dark down the line, and you're sort of prevents you from being stuck. So we do all that analysis up front for you as well. And then I'll get a little bit into the buy, repair, hold DSCR strategy on the next slide, please, Rose.
Okay. Jesse wants to know, how knowledgeable does an LO have to be to work these deals?
You do not need to know the product at all. I can be your right-hand man during the whole process. And to be honest with you, this is what I run into day to day. I had a call this morning with a realtor who hadn't brokered a deal since 2007. I walked her through our fix and flip and ground up process, and she picked up on the program in a span of 30 minutes, and she had no clue what it was before the phone call. So you do not need to understand the product. And the reason that I try and jump on these webinars as much as I can, and work with LOs and brokers on this product, is because not many understand it. So you do not need to be knowledgeable of the product. And we do not expect you to be. All lenders are different in their underwriting and what kind of programs they offer. We're unique in that ours is heavily driven by experience. We don't necessarily think that you should understand that up front. We don't expect you to, because every lender operates differently. So we're always here to help and explain our programs as much as possible. Hope that answers your question.
Yeah, let's see. Zachary says, just wanted to say that Pittman Crow is the man. Best AE. We closed a lot of deals, and he knows his products. When an LO, I don't know all 500 plus product options. I will let him know. Thank you for that comment. It's always nice to have fans.
All right, so like I touched on the previous slide, a true fix and flip would be fix and sell it up, but we also are comfortable with fix and holds. The only difference would be, although we are still concerned with profitability up front, as it would go for fix and flip, for fix and hold, we still calculate profitability, but it's more heavily influenced by an estimate of future market rents. So when we order that appraisal or we order that BPO, we're going to make sure that a 1007 is included in that order, which is going to cover our basis in terms of estimating what we think that your property is going to be able to produce if you're going to plan on holding it at the end of your term. And the reason that we do this is, sure, we could approve the loan and get it across the finish line, but we don't want you to be stuck in the dark when it comes to finding a takeout lender. So this is also intriguing to brokers and LOs that we work with, because a light sort of goes on in their head and they realize, if I can close this fix and hold loan with the fix, flip, and ground up team, LendSure also could close the DSCR loan on the takeout in-house. So now you're starting to look at two loans for your borrower within a span of 12 to 18 months whenever they're trying to move into that DSCR program. So like I said, we offer DSCR financing in-house. Christian and Parker can most definitely help you out with that. But it's also up to you. You can shop around if you want. But yeah, it is a pretty intriguing product for brokers and LOs, because you could be looking at two loans instead of just the one for the fix and flip.
Okay. Raymond, Betsy says, is this only for single family residences?
So we specialize in 1 to 4 unit properties. And we do have a program for 5 to 50 unit. That one is a little bit more high touch. It's only catered to multifamily properties. In that case, we're going to be evaluating debt yield. Max LTC on that one is a little bit lower than what you would usually see. We're not going up to 90% LTC on that product. I think the max is 80 to 85. So it's we heavily focus on 1 to 4 unit residential properties, but 5 to 50 unit is not out of the picture. Yeah, hope that helps.
Okay, great.
Ground up new construction. This has been our absolute bread and butter over the course of the past year. We weren't doing much of these a year and a half ago. Now ground up construction makes up about 50% of our portfolio. And yes, you read that right. We do owner occupied ground up builds. We specialize, like I said, in 1 to 4 unit properties, usually non-owner occupied investment, but now we've sort of rolled out our new program, which is for owner occ builds. And I can get into that as well. Average return on investment for our ground up deals, a little bit over 30%. One thing that we pride ourselves on is, we're not the typical lender that's going to fund the deal and sort of just not care about it when it's all said and done, because they don't have to. A lot of lenders, they're outsourcing the draws to a third party once the loan closes. We're not doing that. We have an in-house draw team, and they're very high touch. And we pride ourselves on having an in-house draw team that people enjoy working with. Our SLAs are typically 3 to 5 days. We send out a third party, usually NVMS, to go inspect the property, confirm proof of completion, send us back a quick report. We verify, we reimburse for the work that's been completed up until that point. Those funds go directly to the borrower and they can be released in a span of 24 hours. We shoot for a maximum of 5 days for the turnaround for a draw, from the day it was requested to the day it's funded back to the borrower. And just backtracking a little bit, they are reimbursements. So the borrower would go out, complete the work. We send out NVMS, provide proof of completion. We reimburse you for work that's been completed. And on loan amounts greater than $250,000, you're only charged interest on funds that have been dispersed. So non-Dutch interest on loan amounts greater than 250K. Which is obviously very helpful for the investor. And one thing we also offer is we provide up to 65% of lot costs through an initial advance. Not many lenders do this. They typically shy away from having dollars out on day one on a lot that has nothing built on it. We don't. If you bought a lot 10 months ago for however much, 200 grand, you come to us, we're comfortable with the deal, we want to do the ground up build, and the equity is there. Say we have some wiggle room, you're qualified for 85% loan to cost based on your experience. Say the rehab budget only gets us to about 82% LTC or 75, whatever it might be. We can provide you with an initial advance of up to 65% of what you purchased the lot for 10 months ago. So that typically gets treated like a cash out. If the property is owned free and clear, if there's a little bit of debt on it, that would obviously go towards covering that to make sure that we're in the first lien position. But yeah, it's a pretty sweet product that a lot of people like taking advantage of. For us to be able to close on a ground up deal, the lot would have to be essentially curb ready, with permits ready to be picked up. So when these deals get brought to us, we're expecting that you have your plans in place, because first of all, we're going to have to send those plans to the appraiser before underwriting takes place to make sure that the after rehab value or the after build value we're calculating for you is completely accurate based on the plans that you provide us. Ideally, we want those plans to be stamped by the county and approved prior to loan funding. Again, like Christian said, we're in the business of making exceptions. LendSure makes more exceptions than anyone. So I just made one the other day on one of my deals where plans and permits, everything's going to get approved and stamped by the county prior to first draw. So that one, we're comfortable with assets. The borrower was extremely experienced. He's done 10 ground up builds in his lifetime. He is a GC. He's self-performing the project. We're comfortable with it. He said, hey man, the county, I think Suffolk County, something like that, they're giving them a hard time with the plans and permitting process. We said, no worries. We understand it's going to take you another few weeks. Go ahead and take your time. We're going to fund the first draw once those are in hand. So we like to work with our borrowers. We don't want to, just give them a hard no. We're going to evaluate every single leg of the deal when we're making an exception. And usually if the deal is if we're comfortable with it, we will make the exception like Christian was talking about. So yeah, it's a little bit about the ground up product.
Okay. Michael wants to know, if someone wants to build to resell, do they need experience?
If they are you asking if they're a first-time builder? We do
Yes.
first-time builders.
Okay, great. And I've got several questions on whether we do manufactured homes.
So we recently started doing manufactured homes. They are a little bit high touch. I'll be upfront with you right now. They got to check a few boxes for us to be able to do it. It's got to be on a permanent foundation. It's got to be manufactured, not modular. When you pull the property profile, it's got to be taxed on both the land value and the assessed value. And then the fourth box you need to check would be there needs to be comparable homes in the area that we can reference for the after build value. If you check all those boxes, we're more than happy to take a stab at it.
Okay. Any issue with urban areas such as Philly?
So I'll give you a little bit of color on that. Our investor group does like us to be a little bit more cognizant of how much leverage we're giving in areas such as Baltimore, Philly, the five boroughs of New York. So in those areas, including South Side of Chicago, stuff like that, those are usually the main areas that we see. There is supposed to be a leverage reduction. It's harder for us to, even if you got that experience in those specific markets, it's hard for us to push up against that 90% LTC range. I just got a deal approved on the south side of Chicago at 85% LTC. So again, exceptions are always made, but I will be upfront. Sometimes there is a slight leverage reduction in those markets, but that's not saying that we're not comfortable lending there. We're just we have a little bit more scrutiny when it comes to evaluating a property that is in those markets.
Okay, great. And I've got a couple of different questions on builder approval process. Can you talk a little bit about that?
Yeah. So we're just going to want to make sure that the GC you're using, we want to make sure that, for one, if the project even requires a GC, if your renovation budget is less than 100 grand and your borrower's got experience doing flips, most of the time we won't even require a GC. Now, if there's an expansion of square footage on the property or a rehab budget of greater than 100 grand or so, we will require a GC. What we'd want to see the GC have is at least 2 or 3 builds under their belt of similar scope. That's definitely something we'd like to see. We'd obviously want to make sure they're licensed. We'd want them to have builder's insurance, and we'd want builder's insurance, want them to be licensed, and we want to make sure their license is in good standing. Those are essentially the 3 things that we look at off the bat. We might request a certificate of occupancy or the building permits for the builds that they've done just to verify underwriting. I won't ask for those, but my underwriters might. But yeah, those are typically the things that we use to qualify your builder.
Okay, great. And I'm getting a few questions that are very specific loan scenarios. Since I want you to get the most accurate and information possible, I'm going to ask you. I'm going to follow up after the webinar so that we can walk through those loan scenarios to get you the most accurate information possible. And finally, is this a 2-time close where you do the construction and the perm?
Yes, unfortunately, we can't do a one-time close up front. We would have to reevaluate the deal when it's closer to time to refinance. It would be a 2-time close. I wish we could do one time, but we can't. And I would like to touch on the question earlier for first timer doing a build. We do not shy away from first timers doing ground up builds. In those scenarios, that's where we like to vet the GC a little bit more. So say you come to us with no projects under your belt, you've never done a ground up build, you got a 700 or above FICO. We're still going up to 80% LTC. I know earlier I mentioned for the fix and flip program, all you need was a 660 FICO to get up to 80. So the ground up is a little bit more stringent. To get 90% loan to cost on a ground up project, you have to have 6 builds in the last 3 years. To get to 85%, it's 3 builds last 3 years. So it's a little bit tougher to get that leverage on a ground up build, but we don't shy away from them. And one thing I also like to note is we now do first time foreign nationals for ground up. It's a product we offer, max 75% LTC. And then if you're not a first timer, we could increase leverage, but we also do foreign nationals, non-permanent resident aliens. We do all that. So.
Okay. Raymond, I'll let you take this one. Or
Okay, gotcha.
yeah, I could take it too if you'd like. This is just something we put together that just like, how do you find these people? How do you find these clients? Since they might be just a different audience um, that you may be aware of. So, but Raymond, if you want to step in and talk about this is just some different ideas that we have on finding new borrowers.
Yeah, sure. So a lot of different ways to find potential borrowers. I literally was on Google the other day, searching through building permits in Idaho, finding builders directly and just giving them calls. That's one way to find a potential, a potential investor that would want to work with you in the future. Also, you can find different social media groups, such as different real estate groups on LinkedIn. I just joined one for, fix and flip investors and builders. I'm going to go pitch now what Lenture has to offer. So there's these forums all over the place. You can find local events, auctions, networking events. These are, very popular in areas like San Diego that I'm in. So it's easy to speak to them. Where I'm located, I'm not sure, obviously if you're in LO somewhere else, I'm not sure how networking events might work in your area, but in San Diego, they're happening almost every freaking night, it seems like. But yeah, that's another good way of connecting with people and sort of just pitching yourself and pitching our products and seeing who wants to bite. And investment clubs, local investment clubs, national investment networks, such as those on LinkedIn as well. Conferences, CMA, you got the Jurassic conference, a ton of, private lending conferences out there that you can attend that are going on pretty frequently. Home flipping seminars, I'm sure those are, more focused to local markets. You could probably find that in your town going on every week. I know that my smaller town that I'm located in San Diego, there's home flipping seminars all the time at different real estate brokerages. Some of my friends are realtors. They invite me to them all the time. Those are always going on. Meetup groups, real estate meetups, like I just touched on, networking events. Yep. Realtors, real estate agents, brokerage firms. Always great people to work with. You never might know what their client is looking to do. They might be helping out a client with the purchase, and there's a rehab component also. Boom, there's a deal for you. Brokerage firms. Yeah, there's a ton of different ways to network, and Rose is a little bit more knowledgeable on this than me, but yeah, there's always ways that you can go out and meet potential borrowers, investors, builders. They're all out there.
All right, thank you. Bank statement loans. Parker, you
All
want to
right, I'll
talk it to
take this
us?
one. Yeah, so we're getting a little bit tight on time, so we'll get through this a little quicker, but these are also the more traditional landscape of non-QM. So you guys might already know a lot of these things, but I'm going to more touch on what makes Lenture unique. So why choose a bank statement loan? It's for that borrower that is self-employed that writes too much off on their taxes, so now they can't show what they actually make. We find that doing a bank statement loan, we're going to be able to document what they actually do make to be able to qualify them for a higher purchase. So you can go to the next one, Rose. What are our underwriters going to look for in bank statement loans? We have a variable expense factor. And what that means is we're qualifying these self-employed borrowers on what their expenses are, not what the industry standard expenses are, right? So let's say you get a real estate agent who doesn't spend that much money to run their business. We're not going to hit them with a 50% haircut just because it's a bank statement loan. What we're going to do is we're going to send them a self-employment questionnaire that they fill out. It's just a 2-page questionnaire. And it goes over a lot of these questions, right? How much overhead does the business have? What is your payroll? What are your cost of goods sold? What are all of your expenses? And now we're qualifying them on their own variable expense factor, rather than just hitting them with a 50% haircut or a 20% haircut with a CPA letter. So we don't have a CPA letter. It's just this questionnaire that should line up with their business deposits and withdrawals. You can go to the next one. So Lenture bank statement programs, we're going to evaluate your income up front if you need to get an income figure prior to approval. Obviously, we prefer to get just a full approval done up front, but if you need an income analysis first, you can send your account executive the questionnaire and the bank statements, and we'll be able to provide you with what we feel like the income will be with both a 12 or a 24-month bank statement program. We do have a P&L program as well, but we do not require P&Ls to use our bank statement program. If you have 24 months of bank statements, we're able to go up to a 90% LTV. If you have 12 months bank statements, we can go up to an 85% LTV, both of those assuming that you have the sufficient credit. The borrower does not have to be 100% owner of the business, and we can do both personal and business bank statements, again, with that variable expense factor. You can go on to the next one. So what I want to touch with here is that our bank statements and W-2 and Social Security, whatever, we can combine income types, especially with our asset depletion and asset qualifier. So the reason that this is important is, let's say that you have a bank statement, a self-employed borrower who we're doing a bank statement loan for them, and we can go up to a 50% DTI. Let's say these guys are at a 55% DTI, but they have 200K post-close assets. We're able to use an asset depletion in combination with our bank statement loan in order to qualify them with more income to bump them down below that 50% DTI threshold that we need to be at. So I'll go over kind of how these programs work. You can go to the next one, Rose. If we are only doing an asset depletion program, we can go up to 80% LTV on these purchases, 75 for rate and term and cash out refis. How we're going to qualify these assets, we're going to do 100% of cash equivalents, so like checkings and savings. We're going to do an 80% usage factor on stocks and investments, 70% of retirement assets unless you are of retirement age. Then we can actually bump that up to 80, and we can now do 50% of cryptocurrency, and that's both whether it's in what you consider a cold wallet or a warm wallet. We can dive deeper into that if you guys have additional questions on that. If we are only using an asset depletion program, which divides by 120, or our asset qualifier program, which divides by 60, you need 500,000 post-close assets. So after your down payment and closing costs, if you have 500K left in the bank, we can deplete from that. If we're using it as additional income, such as you have a W-2 borrower and a bank statement borrower, and they need that extra income per month using our asset depletion program, we need 200,000 post-close assets. We can go as high as a 50% DTI, and if you want to go to the next one, asset depletion divides by 120 months. Asset qualifier, which is our next one, divides by 60 months. So it's the same qualifying assets, 100% of cash equivalents, 80% of stocks, 70% of retirement. If you are below retirement age, 80% if you're of retirement age, and 50% of crypto. The only difference with this one is that we're dividing the assets by 60 months instead of 120 months. Both are 500K or more, and both have no requirement age. I've done an asset depletion loan for a 20-year-old YouTuber before. They don't have to be of retirement age to use our asset depletion or asset qualifier program. There is a little bit more weeds into using an asset qualifier, which means dividing by 60 months compared to asset depletion, our standard dividing by 120 months, but we can dive into that after if you need to get into the weeds of how you qualify with that. Since we're just tight on time, if you want to get into the next one, Christian, with the investor loans.
Sure. Gregory has a question. Which crypto assets do you allow? If it's a shorter list, which do you not allow?
So we can use crypto to deplete from as long as we can prove that it's theirs. So they have a lot of times cold wallets where it's just like on a hard drive, and what we'll need to do is prove that it's theirs by having them transfer a certain amount 2 times into a warm wallet, which is like a Robinhood, where they have some sort of statement, it's their name. We can show those transfers. If that's what he's asking, is we can deplete from all of these cryptos. I don't know if we have a list that we cannot deplete from.
Got it.
We've done, yeah.
Okay. Investor loans.
Thanks, Parker. And last point on the asset depletion program, which will segue perfectly into building relationships with investor loans. Sometimes when we come across borrowers that could qualify using income documentation, but they're high net worth individuals, right? They could have very complicated income with multiple K-1s, and the whole self-employed full doc thing can get very convoluted, right? Keep in mind that a lot of times borrowers with high net worths, they would prefer an easy button, right? Easy and seamless loan solutions are how we are able to create long-lasting relationships, and ultimately how we're able to get repeat business. So following that train of thought, going into investor loans. Next slide, please. I just want to read this slide real fast because I think it brings up a good point. And it says, property investors usually don't stop with just one property. As they build their loan portfolio, it may mean a steady stream of purchase and refinance business for years to come. So I think it's important for all of us to understand, how do investors think? Well, they think in terms of scaling, they think in terms of speed, how fast can you get this loan done for me? And they think in terms of opportunity, right? So how do we align our financing solutions to ultimately meet this or that investor's needs, right? Because if we're able to do that, that's how we can ultimately build trust, and that's how we are going to be able to create these repeat customers for multiple loans, right? So next slide, please. So diving into it, you can go back. Yeah, just real quick on this one. I just want to make sure everyone is aware that as far as the total or the wide spectrum of programs that we offer for investor loans, we can do full doc loans, we can do bank statement loans, DSCR, foreign national, it all applies, right? What I really want to focus on today, though, is DSCR, just real quick. Next slide, please. So on that train of thought of ease of use, DSCR is the perfect loan solution for your experienced property investors. For those of you who may not be familiar with DSCR, DSCR is an acronym that stands for Debt Service Coverage Ratio. And why is it the ease of use loan program? Because we are not collecting any income documentation. The loan is solely qualified on the cash flow of our subject property. So in essence, all we need is, when we look at our new starting payments, right, either our PITI or our ITI, if we're going with an interest-only term, and I'll touch on that later, we just need the rents to cover or cash flow that payment. That would equate to a 1.0 ratio. We do have other options for negative ratio loans down to a 0.75 at reduced LTVs. And we also have a no ratio program, which would be anything less than a 0.75 DSCR ratio, beginning at 60% loan to value and under. Now, aside from not having or not needing to collect income documentation, the other thing I really want to hit on this is the easiest way to think of a DSCR loan is our DSCR ratio is replacing our DTI ratio, right? And because of that, when we think about these experienced property investors that come across our desk that are looking for ease of use, we typically see that they have very lengthy REO schedules, right? And so if you think about it, if we were going with a traditional income qualified loan, what would that mean? That would mean for every REO property they have, we would need to collect proof of taxes, proof of insurance, and proof of HOA dues if applicable, right? Well, again, now, because there is no DTI, all we really care about is has the borrower paid their mortgages as agreed for the last 12 months, right? Do we reflect a 0 by 30 by 12 mortgage rating, right? So as far as the overall documentation required to close a DSCR loan, it's very simplistic. It's 1003 credit, last 2 months of asset statements, and that's about it as far as the pre-approval is concerned. And then the last thing that I would mention is how or what rents are we using to qualify the DSCR loan. If it's a purchase transaction, we are looking at the 1007 rent schedule that we would order on an appraisal. And if it is a refinance, we would end up using the last 2 months of bank statements or canceled checks to be able to show the rent payments coming in and to make sure that those match up with the lease agreements that we would also gather as well.
Okay.
Rose, quick question. The timer says we have 40 seconds. Is this going to shut off when we're done, or?
No, it's not.
Okay.
We're fine.
Okay, sigh of relief. We will try to wrap up quick though. Real fast, I do like to mention the 1040 interest only option at this point in the presentation. Keep in mind that when we are talking about investment transaction, we are talking about business purpose loans, right? meaning these loans do not abide by TRID regulation, okay? And so what that means is when we're qualifying our DSCR ratio, we do not need to qualify that based off of the fully indexed or fully amortized payment, right? So earlier I mentioned based on the PITI or the ITI payment. In cases where we have higher levered DSCR loans, around, call it 80% loan to value, a very good tool that we've been using lately to get deals to cash flow over one for the best rates is going with the interest only option. The interest only term is a 40-year fixed rate where the first 10 years are IO payments, followed by a 30-year fully amortized payment. During the IO period, the borrower still has the option to make additional payments towards principal if they would like. It's just obviously not obligated. But again, most importantly, we're getting these deals to cash flow. And if you were to ask your investor clients, what their main goal is, a lot of times they're saying, my main goal is to cash flow as strong as possible, right? And this interest-only solution is enabling them to do that. Keep that in mind.
So we also do DSCR not only with 1 to 4 units, but also we have a 5 to 10 unit DSCR. There's a little bit different pricing regulations to this, and we have to, instead of be at a 1.0 ratio, we need to be at a 1.1, meaning we're making a little bit more than just breaking even. 1.0 is breaking even, the rents cover the payments. 1.1, we're making a little bit of money. So with 5 to 10 units, we can go up to a 75 LTV on a purchase, a 70 LTV on a rate and term refi, and a 65 LTV on a cash out refi. I just priced a 5 to 10 unit out today, and we were at a 6.875% rate and lend sure to charge 2 points. So we're industry leading with these pricings on the 5 to 10 units. And the nice thing that we haven't really tapped into it yet, we can get into it later, is our stacking ability. So we can finance points in, similar to how mortgage insurance premium, the dollar amount is financed into the loan amount. So when we're charging these 2 points on 5 to 10 units, we can finance it into the loan amount. So it's better than a borrower charge, and it's better than a yield spread because our rate stays low and it's financed into the dollar amount on the loan amount. So the main thing that we're going to want to look here is for 5 to 10 units is, number one, are they cash flowing? Is the borrower's profile good, and do they have any experience? We can go up to $2 million loan amounts, but I've seen us grant many exceptions on these to go higher.
Actually, this is a typo, and my apologies for that, but on the rate sheets, it's now up to $3 million.
$3 million.
Yeah. Is stacking only on 5 to 10? No, we offer stacking across our programs.
Yep, all purchase it, yeah.
Okay.
All right. Real brief on this slide. So again, as I showed earlier, we have a lot of different income documentation programs for investor loans. One thing that is important to note is when we are going full doc or bank statements, really, we have a unique way of calculating negative REO income, right? So on your end, if you're trying to qualify an investor loan in-house and you're running into DTI issues and the borrower has real estate owned, give us a call. Because essentially how we view negative rental income is the same way how on the conventional side you would view or treat alimony, right? So if we have an REO property that's receiving negative rental income with that 75% vacancy factor, instead of applying that negative amount to the liability section of your DTI calculation, we would move that to the income section and subtract it from income, which makes a positive benefit to our borrower as far as qualifying DTI. So as an example, if we have let's say a W-2 borrower that's making $10,000 a month, and the borrower has a investment property where they are losing $500 a month, we would take that negative 500, subtract it from income, and so now the borrower would have a net qualifying income of $9,500, rather than including a $500 monthly liability now towards the DTI calculation. So just a little trick there that we have up our sleeve.
Okay.
Next, we'll tackle special property types. So non-warrantable condos and condotels. So there's a million different reasons why a condo can be non-warrantable, and it keeps increasing. I swear every condo that I'm running into is non-warrantable for some reason. So some examples of these are if the project is not 100% complete, or if the reserves requirement is low. Maybe there's ongoing litigation on these properties. If you have a non-warrantable condo, send it over. We're going to take a look at all of these, even if there is ongoing litigation, including structural litigation. A lot of lenders hard stop at litigation. Some might not, but I've seen every other lender is a hard stop at structural litigation. We'll still even take a look at those. We're just going to want to see, what is the litigation for, and is it directly affecting our unit, and what the HOA reserves are behind everything going on. So, for example, I'll give you 2 examples here. I did a condo in Park City, Utah. There was an ice rink below the condo, and a kid slipped and cracked his head open, and so they were suing the HOA for it. So there's ongoing litigation there, but it has nothing to do with our unit. So we still funded those loans in that complex. Even structural litigation, I was doing loans in California on these condos, and their seawall was cracked. That's structural litigation, but it has nothing to do with our unit itself. So we were still funding loans in that complex. So I guess what I want to tell you about these special properties is, if you're running into them and you think there's no way that anybody's going to do this because of the litigation, structural litigation, whatever it is, still give us a chance, send it over to us. There might be something that we can do. So our condos, we can do all of the normal programs with it, right? So whether it's 12 or 24 month bank statement, full doc, 1099s, asset depletion, DSCR, foreign national, the merged income types, whether it's bank statement and asset depletion, all of these different programs still fit within our condos. So we can, again, on these condos, even we can go jumbo loans up to 3 million, just like any other, and exceptions to go higher if we need.
Okay. And merged income tax.
Yeah. So you can go to the next one. We can get into condotels. Christian can get into condotels.
Perfect. All right, condotels. One of my all-time favorite loans, because whenever we come across a borrower who is looking to purchase a condotel, I can tell you most times they are extremely qualified borrowers and typically very easy loans. So for those of you who may not be familiar with condotels or condo hotels, a condotel, which are typically found in resort town areas, such as where we're here in Utah and Park City, right? We see those a lot there. A condotel is essentially a hotel unit that a borrower is buying, right? It's a condo that has the look and feel of a hotel, meaning it could have key cards, it could have a front desk service, cleaning service, so on and so forth. But I want to be clear, though, that does not actually define, per definition, what a condotel is. The definition of a condotel is when the HOA handles the nightly, weekly rental bookings. Okay. For those of you who might be familiar with St. George, Utah, down in southern Utah, a couple of years ago, there was a townhome complex. Well, I should say they looked just like townhomes, didn't have a front desk service, none of that. The lender that ended up bringing them to us actually funded these loans, but had a post-funding condition of the CCNRs. They came back and showed that there was a nightly, weekly rental pool, and they had to unwind all those loans and send them to us. So even though they didn't have the look and feel of the hotel, again, they had the feature of the rental booking pool. So keep that in mind. As we talk about condotels, the main, you can go to the next slide, main guidelines to be aware of for purchase transactions, we will go up to 75% loan to value, 70% loan to value for rate and term, 65 for cash out refinance, and then up to 70% LTV for DSCR programs. So all the LTVs I mentioned prior would be for investor income qualified loans. Keep that in mind. Typically, these are investment properties, which is why that second to last bullet point mentions that investor concentration is okay, actually up to 100%. So when we're looking at that HOA questionnaire, totally fine there, because again, the design of these is to be an investment property. But with that said, it is okay for the borrower to own this as a second home, and even actually primaries on an exception basis when we can show proof that the borrower can opt out of the rental pool. The last hard guideline that we want to be aware of is typically we want these condotel units to be over 600 square feet. But with that said, and again, another example of one of the many exceptions that we make is when we come across condotel units that are less than 600 square feet, we will consider those at reduced LTVs, typically around 60 to 65%. But the main qualifying criteria that we want to be sure of is, does the unit have a full-size kitchen, meaning a built-in fridge, no hot plates, right? So an actual stovetop, things like that, right? Basically, making sure that the unit is fully livable. Okay.
Foreign nationals.
Okay, foreign nationals. So if you want to, yep, here we go. It's defining terms first. A lot of people kind of get mixed up with what a foreign national truly is. So a true foreign national is somebody who lives and works outside of the U.S. They want to buy investment properties here, but we also do second homes here. So I'm doing 2 this month. One of them's buying an investment property using our DSCR program. The other's buying a second home using their income. We get a WVOE and history of their income. So the only thing that we cannot do for foreign nationals are purchase a primary, because a foreign national truly does live and work outside of the U.S., so they cannot have their primary home here. We can go to the next one. So the visa types that are allowed, there's I won't read all of those, but that's a list of visa types that are allowed. We can grant other visa types with senior management approval. And what we're going to want to get with these borrowers is their residency status papers, right? Where do they live? What visa do they have? And just all of their residency docs to prove that they are a foreign national. And we can go to the next one to get into the program. But if you're confused on what a foreign national is and what we can do there, and if we accept these certain, whether they're from this certain country or this certain visa type, just call your account executive. We can read you out, because there are some in-depth guidelines. But as far as qualifying these foreign nationals, we do not require a credit score, but we do have trade line requirements, right? So we want to see that they have 3 total trade lines with 2 open. So whether that is they have a credit card or 2 or a few in their home country, an auto loan, maybe they have a mortgage. We can kind of build up our own credit report by using these credit reference letters from their banks if they don't have a credit report. So for example, I've done tons of foreign nationals, Canadian borrowers. They have a credit report that is very similar to ours. We can just use that credit report. But I've done tons of borrowers from Vietnam. They don't have credit reports out there, right? So we go to their banks and we get translated docs of credit reference letters saying, this is our borrower, this is their balance, this is their payment, and they have made their payment as agreed. And so we can do these purchase loans up to 75% LTVs and refis up to 70% LTVs. We can still do these special property types. So all the same program and guidelines still apply, but for national is up to 75 LTV with the same property types. Still can go DSCR as well.
Let's take this thing home. So the lend share process, next slide, please. So as mentioned before, want to make sure you are aware of a couple resources. I'll touch on one. Rose will touch on the other one here in just a second. But Spark by LendSure is our online pricing tool that is always available to you guys. Spark is a very user-friendly system where you'll plug in minimal loan details, and it'll spit out some pricing options for you with par rate, buy down options, lender credit options, you name it. The only thing that I want to mention on this, again, going back to a comment made earlier, is with the sheer amount of exceptions that we make here at LendSure, just keep in mind that the Spark pricing tool is pricing out loans that fit within guidelines, right? So if you price out a scenario and it comes back with no result, that probably means that something does not fit within guidelines. And so again, here at LendSure, all of our account executives really strive to create relationships with the brokers that we are working with. And so we prefer to talk about every single loan scenario with you guys, so we can dive into the details, tell you what we think about it, tell you where we think LTV is going to land, so on and so forth, and provide some good pricing. So Spark's a great tool, but again, make sure you utilize your account executive. Vlad. And then the loan share process. One thing that's very unique about us is how we handle loans in the pre-approval section of the life of the loan. Okay. Other lenders that you may work with may give you very quick, high-level pre-qual answers. Giving you a quick yes up front, but not really diving in depth into some of the nitty-gritty details of the loan. We prefer to operate a little bit different. We recognize that the borrower's time is valuable, your time is valuable, and so is ours. We do not want to disclose on loans, for the most part, that we are not confident, at least I should say 100% confident, that we are going to fund. And so with that said, we do our heavy lifting up front. So when we get a pre-approval loan scenario over the phone, typically what we're going to do is email over a needs list of the 5 main components of the loan, which would be the 1003 credit, income docs, asset statements, and then something on the property, whether that's purchase contract or mortgage statement, something again on the property there. And then any miscellaneous documents that may be necessary for this given file, such as, for example, a 1099 work contract, right? Once we receive those documents, we send this in for a manual underwrite up front, where within 48 hours, we will actually have a member of our senior management team review the loan and provide final approval, pricing, and terms for this loan. So again, we want to make sure that we're letting you and the borrower know up front that we have a real option for you, and from there we proceed to the normal stages of the loan with initial disclosures, conditional loan approval, CD, and clear to close. So.
And if you're not familiar, or if you don't know who your account executive is, or if this is the first time working with Lenture, just go ahead and respond to the email from me, Rose Waldy, that you're going to get in about an hour, and I will be delighted to connect you with your Lenture account executive. Now, we've been talking about a lot of really innovative programs today, but how do you start marketing to them? Well, I put together this lovely little kit for you, and there's the URL to access it. Don't worry, I'm going to send everybody a copy of this slide deck. But this contains a ton of great resources, including flyers that you can put your logo on, your contact info, even your disclaimer on everything from like fix and flip, ground up, 5 to 10 unit investor loans, all of it. So to access it, just click on that link and download it.
Okay, last thing, why partner with Lenture? So outside of the unique programs, the fact that we can grant exceptions, the main thing that I want to hit on with why partner with Lenture is going to be the communication and the customer service between the account rep and to you guys. I know that for myself and for Christian when he was producing and now as a manager, and I know for Raymond it's the same. We pride ourselves on communication and giving you the best customer service that you will experience. I know that for us, you won't find another account executive that is better at communicating and that has quicker response times and that will hold your hand better through brokering, because I know a lot of times brokering can be scary. You're giving up control. You're not running the loan yourself, and we understand that. And we want to provide you with the best experience possible, because we realize that it's also your relationships on the line, not just our relationships with you, but your relationships with your borrowers and your realtors and your builder partners, whoever it is. So outside of the unique programs and the fact that we can close loans fast and smooth and all of that, it's going to be the reason to partner with Lenture is the relationships that we have with you guys, and the fact that we're not going to have you just send documents and not get back to you. A lot of times I've heard plenty of my loan officers say brokering non-QM is like sending documents into a black hole. I sent them in and I never hear back. My loan didn't close for 3 months. We're not like that, and I can personally guarantee that your experience will not be like that with us. So we want to make you feel as comfortable as possible, that you want to work with us, that we're your partner, and we want to help you close more loans and build the relationship for both of us, the mutual benefit. So that's all I'll have to say, and we can move on to any additional questions that you guys might have.
Okay. So yeah, and now is the time to submit any questions that you haven't had answered yet. Justin wants to know, on the bridge loan, do you require the purchase of the new home to also be with Lenture?
So we have two separate bridge loans. The one that I wanted to talk about was the boost bridge loan, which means lender finances both the bridge and the purchase, because that's the one that happens most often. We do have a different bridge loan. It depends on what company you're with if they have that bridge loan signed up with us, but we do have that option of a standalone bridge loan. So it's the same structure. We're giving you 12 months. We're doing the cash out. There's no monthly payments. The only difference is the rate is an 8.75 instead of an 8.5, and our max LTV is 70 instead of 75. Now that gives us the ability to give you that cash to either, number one, buy the new purchase property in cash. That happens a lot with retired couples. They're downsizing their house. Their kids moved out. They went to college. They don't need these 8-bedroom homes anymore, right? They're going to downsize and they're going to buy a smaller home in cash. So we do have a standalone bridge loan that works for that. The other option would be if you want to finance the purchase yourself elsewhere. The only thing that I would say is you might run into a problem qualifying when you're running into that new purchase elsewhere, because we are not a backup guaranteed contract. Therefore, when you take the purchase loan somewhere else, they're going to have to hit them with some sort of payment because we are not under contract to buy the home. They still own the home completely outright. We are just in first lien position as a cash out refi balloon note due in 12 months. So when you take the new purchase, if you are taking the new purchase elsewhere to finance it, you have to be aware that, hey, they might have to hit them with a payment, and my borrower either has to qualify with this payment, or we're going to have to switch back to the boost bridge loan where Lensure does it because they don't have to qualify with them hitting them for any payment whatsoever. Does that make sense?
Okay.
Hopefully I answered that completely for you.
Okay. And Kathy says, condo presale not met, will Lenture loan on it?
Condo presale, I suppose I'm confused by the question. Are we talking about new units or a new complex where we're potentially the first one in? That's a question
Yes.
I would need a little bit. Okay. So
Well, that's how I interpreted it.
okay. So when we are dealing with a new condo complex, typically we will consider being the first lender in. While it's not something we want to do, we will look at it at reduced LTVs. With that said, we want to make sure that on the appraisal, we have at least one closed comp within the complex. Typically that, might be a cash sale. We specifically would like to, try to figure out, okay, how long until we can get some more financed options to be able to look at those comps as well. But yeah, bottom line is for the first one in, we've done those before, and we will do them up to certain exposure limits.
Okay. Now, with that, I want to say thank you to everybody who took the time to join us today. Again, look for an email from me, Rose Waldy, in about an hour. That's going to have the recording. It's going to have the slide deck. It's going to have the link to the private label resources. And I'll even include a brand new piece that I just completed yesterday, which is a cheat sheet on the ground up construction and fix and flip program. Christian, any parting words?
No, well, I guess yes. We appreciate your guys' time. Thank you so much for joining us. And again, as Parker mentioned, as we've mentioned a few times on this this webinar, we really strive to have relationships with each of you. We do not want to be just another non-QM outlet, right? We want to be that trusted consultant, that trusted resource where you can call with questions and we can structure loans together. So we urge you to pick up the phone and call your account executive and start doing some business together.
Okay, Parker, any parting words?
Nothing for me. Yeah, just excited to start working with anybody that we haven't worked with before. Ready to get going.
Awesome. Raymond, any parting words?
Yep. Thank you guys for your time, and hopefully looking forward to introducing more of you to our fix and flip and ground up programs and hearing from you guys in the near future. But yeah, thanks again for all your time.
All right. Thank you, everyone. Bye-bye.